All right, before we dive in, let's get one thing straight. As you can see on the screen, today's analysis is for your reference only, to help you make your own informed decisions. If there's one thing I've learned in over 20 years in this game, is that every single decision and all the responsibility that comes with it rests with the investor. I'm here to give you my analysis, not to write your shopping list. We're clear on that? Okay, let's get right into it. The question you see on the screen is the very thing that's keeping smart investors up at night. What's that one thing we might look back on in a few years and kick ourselves for missing? I was there for the dot-com bust. I was on the trading floor during the Lehman collapse in 2008. I know what a massive fundamental shift feels like in my bones. And right now, my gut, and the data we're about to look at, is telling me that one of those moments has arrived again. Welcome to Understanding the World Through Stocks. Today, we're tackling a topic I feel like I've waited my entire career to talk about. It's the story of how the KOSPI finally broke free from the chains that have held it down for 30 long years. Now, if you've been with me for a while, you know I'm not one to get easily excited. I always try to be the most pessimistic guy in the room when it comes to the market. But what we're witnessing right now, well, it's on a whole other level. This isn't just another bull market. Frankly, it's closer to a revolution. So let's lay out our investigation plan for this massive event. First, we're going to pinpoint the exact moment this all began. Second, we'll follow the money. Why on earth did foreign investors suddenly change their minds about Korea? Third, we'll analyze the powerful one-two punch delivered by the government and corporations. Fourth, we're putting the banking sector, the sleeping giant, under a microscope. And finally, we'll put on our strategist hats and hunt for where the next opportunity might be hiding. All right, Section 1, the myth begins. I use the word myth for a reason, because what happened was almost unbelievable at the time. This wasn't just the market going up a bit. This was the very ground beneath our feet shifting. Just look at this number on the screen, 5,454.62. I mean, it wasn't that long ago that KSP 3000 felt like a dream. This is a different dimension. I vividly remember the devastation after the '08 crisis, and I remember the sugar high rally fueled by pandemic liquidity. Both of those felt puranago, temporary. But this feels different. It feels solid, like a number the market earned for itself. And that brings us to this question. Is this rally just another bull trap, designed to lure in unsuspecting investors? Or is it the dawn of the genuine re-rating we've been waiting decades for? The skeptic in me, forged by 20 years of market betrayals, is always on high alert. But the data we're about to see presents some very, very powerful evidence. Now, this is where the story gets really interesting. Take a close look at this table. You see retail investors exhausted by years of volatility cashing out to the tune of over 5 trillion won. It's an understandable move. But who do you think was on the other side of that trade, buying up everything they sold? Look at the positive numbers on the right, foreigners and institutions, the very players we call smart money. The message here is crystal clear. This wasn't a bubble created by public frenzy. This was a calculated re-rating of the entire market by the pros. So that leaves us with the biggest question of all, why? Why now, of all times, do the big money players around the world suddenly start looking at Korea again? In our second section, we're going to uncover the evidence piece by piece. What you're looking at right here, this was the game changer, the amendment to the Commercial Act. Think of it like this. Before, a director's legal duty was only to the company. That was a massive, ambiguous loophole management could drive a truck through. But now the law explicitly states their duty is to the company and its shareholders. That one little word, and, is the revolution. For the first time ever, directors can be held personally liable for decisions that harm minority shareholders. This is the exact change that global funds, from Goldman Sachs to BlackRock, had been demanding for years. On top of that legal shift, we got this massive tailwind, Korea's inclusion in the World Government Bond Index, or WGBI. Now hang on, I know that sounds technical, but it's really simple. Just think of the WGBI as the S&P 500 for bonds. Huge pension funds all over the world are required to buy bonds from countries in this index. That means up to nearly 100 trillion won is now lined up to buy Korean assets, creating massive demand for the Korean won. For a foreign investor, this is critical. It removes the worst-case scenario of making money on stocks but losing it all on the currency exchange. It was a giant de-risking event. Okay, so now we have a legal shield for investors and a stable currency backing them up. The final piece of the puzzle was the magnet to actually attract the money, the right incentive structure. Let's look at the value-up collaboration in Section 3. Look at this number, 45%. This was the tax cliff waiting for any investor with significant dividend income. It was a literal wall. No matter how much a company wanted to reward its shareholders with higher dividends, why would they, if their biggest shareholders had to immediately hand over nearly half of it in taxes? It was a system that effectively punished shareholder-friendly behavior. And this table shows the elegant solution. You don't need to look at all the numbers. Just look at the far right column. The government created a separate, lower tax bracket just for dividend income. See how the top rate drops from 45% all the way down to 30%? This one change completely altered the rules of the game. Suddenly, companies had an incentive to pay dividends, and investors had an incentive to demand them. It was the moment the floodgates of capital opened. So where did all this capital, now armed with new legal protections and tax incentives, go? It flowed into the most undervalued, most unloved corner of the market. Let's talk about the great awakening of bank stocks in Section 4. Words have power, especially when they come from the chairman of a major bank. Look at this sentence: no upper limit. I've read thousands of earnings reports in my career, and I have never seen language this strong. Usually, it's all cautious, bureaucratic jargon. This was a direct signal to the market. The era of hoarding cash is over. Our new mission is to return it to you, the owners. And they didn't just talk the talk, they proved it with action. 1.2 trillion won. That's how much they spent buying back their own stock, and quite literally, setting it on fire, canceling it. Think of it like a pizza. By reducing the number of slices, you make every remaining slice bigger. It's not a promise of future dividends. It's the most direct and powerful way to immediately increase the value of every shareholder's stake. KB Financial's bold move lit a fire under the entire sector. Just look at this bar chart. Once KB made its move, Shinhan suddenly had to announce a 50% target. Meritz went even further. A virtuous competition broke out to see who could be the most shareholder-friendly. This is exactly the kind of healthy dynamic the market loves to see, and it was the key driver that led to the re-rating of the entire banking sector. Okay, bank stocks had a phenomenal run. Maybe the easy money has already been made there. Our job as smart investors is to always ask, what's next? Let's move to our final section and look for the next opportunity. To find the next opportunity, we have to read the global macro environment, and that means reading the minds of the U.S. Federal Reserve. This table shows what I call a Goldilocks scenario. Interest rates are expected to stay high enough for banks to make good money on loans, but they're also expected to come down gently enough not to choke off the economy. For a bank, this is the perfect sweet spot. It's an ideal environment where they can run a profitable lending business without facing the risk of massive defaults from a deep recession. So how do we operate in this new reality? Here is my 20-year playbook condensed into 4 simple rules. First, use a stop loss. Your biggest enemy in a bull market is your own greed. Protect your capital first. Second, rebalance. Trim some profits from your big winners and add to areas that haven't run up yet. Don't let one stock become your entire portfolio. Third, be patient. This isn't a one-week trade. It's a multi-year story unfolding. And fourth, and this is the most important, watch the policy. The government's actions started this fire. If you see signs they're taking away the fuel, that's when we need to be cautious. So I want to leave you with this final question. For the past 20 years, the first term every foreign investor learned about the Korean market was the Korea discount. It was the price we paid for terrible corporate governance. But considering everything we've seen today, the changes in law, the tax incentives, the shift in corporate behavior, could it be that we're finally entering the era of the Korea premium? If you only remember one thing from today, make it this summary on the screen. The new laws provided a shield to protect investors, the new tax system became a magnet to attract capital, and corporations proved it was all real with their actions. If you found this kind of deep dive analysis valuable for your own investment process, a simple click on the subscribe and like buttons really does give us the fuel we need to continue our mission of understanding the world through stocks. Until next time, stay curious and invest wisely. This has been Understanding the World Through Stocks.